What's up, my friends? What's up, my friends? Excited to go live again, man. I'm really digging these lives. I hope you are too. Today we're talking the Fed. So much has happened. Yesterday's Fed meeting happened. Thank you for joining me here. Welcome. Good morning. Throw your comments in there. Say hello on your way in. Give me the like button on your way in. And let me pull up those comments. Let's see. Where are they? Let's see. There they are. All right, cool. So say hello. What's up, you guys? This is going to be fun. We got a lot to talk about today. We got the Fed meeting. We got interest rates going up. And what is that going to do to the housing market? What's that going to do to stocks? What's that going to do to finance overall? We are going to find out today. Let me say hello to you guys in those comments, in the chat, I should say. Say hello back. What's up, you guys? So like I said, lots of cool stuff going on. I'm going to save you the trouble of watching the whole synopsis of the Fed meeting because I'm going to give it to you right here. We're going to show some highlights. I'm going to share my perspective, my opinion, my advice on what's going on. And then, of course, what you should do, what we can all start doing in advance of what's happening with interest rates, inflation, and the economy. And again, the channel is all about finance, freedom, and fun. And so if you like those things, if you're not already subscribed, make sure you do. And by the way, if you're not seeing my videos, if you're not seeing the notifications of the new videos that are coming out, make sure you hit that bell icon on the channel. All right, let's see. For some reason, we got kicked off, but I'm back. What's up, you guys? What's up? What's up? All right, so we had a couple of you on. Let's get some more folks on, and we will go ahead and get started. For now, just let me know, where are you watching from? I'm curious. Throw it in the chat box. Where are you watching from? What city? What state? I'm here now in the Dallas-Fort Worth area. California escapee, I should call it. I need a shirt like that says California escapee. I always tell everyone that we escaped just in time. We got out of there, but still have a lot of friends, family there, and those kinds of things. So welcome to the broadcast. Thank you for being here. I see that the notification just went out on YouTube, so now YouTube knows we're live as well. So thanks for being here, you guys. Really appreciate you guys. Really appreciate you jumping on. And we're going to go ahead and get into it. And let's take a look at what Jerome Powell said yesterday. I'm going to play some clips from the live. I think it's good. Kind of tells us exactly what happened here, and I will show you what he said, and then I'm going to give you my perspective. So I'm just going to give you a little summary. Don't worry, it's not going to be the whole thing. You don't have to get freaked out that you're going to have to watch an hour of finance stuff. I'm going to give you my perspective on it. So let's go ahead and jump into that. Let me just get this going for everyone, and here we go. Here we go. Okay, so here's the video, and let's just watch the intro here.
Good afternoon. It's nice to see everyone in person.
Well, it would be nice if we played the sound from that. Let's go over here. Here we go. All right, good. All right, let's do it. Let's rock it, you guys.
For the first time in a couple of years. Before I go into the details of today's meeting, I'd like to take this opportunity to speak.
Let's see if you guys can hear that. People. I don't know if you can.
Inflation is much too high. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses.
Let's try that again. For some reason, I couldn't hear it, but I think you could. So that was interesting. All right, here we go. Let's try that again.
The economy and the...
Let's go back to where we started.
Inflation... Good afternoon. It's nice to see everyone in person for the first time in a couple of years. Before I go into the details of today's meeting, I'd like to take this opportunity to speak directly to the American people. Inflation is much too high, and we understand the hardship it is causing, and we're moving expeditiously to bring it back down. We have both the tools we need and the resolve that it will take to restore price stability on behalf of American families and businesses. The economy and the country have been through a lot over the past 2 years and have proved resilient. It is essential that we bring inflation down if we are to have a sustained period of strong labor market conditions that benefit all. From the standpoint of our congressional mandate to promote maximum employment and price stability, the current picture is plain to see. The labor market is extremely tight and inflation is much too high. Against this backdrop, today the FOMC raised its policy interest rate by a half percentage point and anticipates that ongoing increases in the target rate for the federal funds rate will be appropriate. In addition, we are beginning the process of significantly reducing the size of our balance sheet. I'll have more to say about today's monetary policy actions after briefly reviewing economic developments. After expanding at a robust 5.5% pace last year, overall economic activity edged down in the first quarter. Underlying momentum remains strong, however, as the decline largely reflected swings in inventories and net exports, two volatile categories whose movements last quarter likely carry little signal for future growth. Indeed, household spending and business fixed investment continued to expand briskly. The labor market has continued to strengthen and is extremely tight. Over the first 3 months of the year, employment rose by nearly 1.7 million jobs. In March, the unemployment rate hit a post-pandemic and near 5-decade low of 3.6%. Improvements in labor market conditions have been widespread, including for workers at the lower end of the wage distribution, as well as for African Americans and Hispanics. Labor demand is very strong, and while labor force participation has increased somewhat, labor supply remains subdued. Employers are having difficulties filling job openings, and wages are rising at the fastest pace in many years. Inflation remains well above our longer-run goal of 2%. Over the 12 months ending in March, total PCE prices rose 6.6%. Excluding the volatile food and energy categories, core PCE prices rose 5.2%. Aggregate demand is strong, and bottlenecks and supply constraints are limiting how quickly production can respond. Disruptions to supply have been larger and longer lasting than anticipated, and price pressures have spread to a broader range of goods and services. The surge in prices of crude oil and other commodities that resulted from Russia's invasion of Ukraine is creating additional upward pressure on inflation. And COVID-related lockdowns in China are likely to further exacerbate supply chain disruptions as well. Russia's invasion of Ukraine is causing tremendous loss and hardship, and our thoughts and sympathies are with the people of Ukraine. Our job is to consider the implications for the U.S. economy, which remain highly uncertain. In addition to the effects on inflation, the invasion and related events are likely to restrain economic activity abroad and further disrupt supply chains, creating spillovers to the U.S. economy through trade and other channels. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship, especially on those least able to meet the higher costs of essentials like food, housing, and transportation.
All right, guys, so let's take a quick break here just to, I have some other highlights for you. I just wanted you to see that beginning. So basically, just a quick summary for if you just jumped in here, thank you for being here, guys. Let's do some comments here. So Blaine joining us from California. Torrance, hey, man, it's a beautiful place. Unfortunately, the politicians kind of ruined it, but I live pretty close to you. And Reva's telling Blaine that he's got to leave. And hello. Hey, what's up, you guys? So thank you so much for joining me. Quick summary of what we just saw. So basically, yesterday the Fed had a meeting. And, I think the interesting thing here is to listen to, Jerome Powell had said a couple of times there that the goal of the Fed is price stability, maximum employment, low inflation. They want to keep inflation about 2%, and I think inflation now is about 8%. So that is very uncomfortable for them. They don't like that. They don't want that. Interest rates have been historically low, and so the response from the Fed was to raise interest rates by 0.5%, 50 basis points in the meeting yesterday, which they haven't done in a very, very long time. He's also signaled that he's going to continue, or they are going to continue to raise rates by 0.5 point or 1/4 point, depending on, I just got a comment that it's hard to hear me. Let me put my mic, having some mic issues. Let me. Lav mic. Okay, there we go. Now you should be able to hear me better. If you can, give me a thumbs up or let me know if you can hear me better that way. All right, so basically, what Jerome Powell is talking about here is that he's raising rates. They're raising rates. They're going to continue to raise rates to get inflation under control, right? And so that is their goal. Their goal is maximum stability in the economy, low inflation, maximum employment. And so that is what they are doing at this meeting. So let's listen to a little bit more. I have a couple more really good highlights for you here of the meeting that I want to show you. And so let's go ahead and check that out. Let's go back to the video here. We got some stuff going here at 13 minutes. Okay, here we go. Hang tight one sec. Okay, let me show you. Forgot that I got to do this. Okay, there we go. All right, here we go. Let's check this out.
Together than they are, and that would give us a chance to have lower get inflation down, get wages down, and then get inflation down without having to slow the economy and have a recession and have unemployment rise materially. So there's a path to that. Now, I would say I think we have a good chance to have a soft or softish landing or outcome, if you will, and I'll give you a couple reasons for that. One is households and businesses are in very strong financial shape. You're looking at excess savings on balance sheets, excess in the sense that they're substantially larger than the prior trend. Businesses are in good financial shape. The labor market is, as I mentioned, very, very strong. And so it doesn't seem to be anywhere close to a downturn. Therefore, the economy is strong and is well positioned to handle tighter monetary policy. So, but I'll say, I do expect that this will be very challenging. It's not going to be easy. And it may well depend, of course, on events that are not under our control. But our job is to use our tools to try to achieve that outcome, and that's what we're going to do.
Okay, so that that Jerome Powell wants to do as a goal, of course, is he wants a soft landing to the economy. What that means, you guys, is that we don't have a recession. They don't want a recession, obviously. And so what Jerome Powell is saying in these comments is that he feels, based on what he based on microeconomic conditions, that the economy can handle the higher rates, right? And I've been talking about this a lot on the channel. Are higher rates going to cause a recession? A lot of people are talking about that. A lot of people are saying that they think a recession is either already here, coming later this year, or coming next year. That's the majority of people are saying that. And so that's the big question. And so what Powell is saying here really is that he doesn't believe that there's going to be a recession. Now, obviously, his job is to say that there isn't going to be a recession. If he came out and said, hey, we're headed for a recession, that would probably be a bad thing. So we got to take those comments with a grain of salt, of course. And I have, like I said, I've been talking about it here on the channel with my most recent videos about kind of what's been going on, and are we headed into a recession? Are we headed for a housing market crash because of the higher mortgage interest rates and what those are causing? So we got some interesting stuff here. Now, Powell's main reasoning for this is the labor market is strong. I'll play some more clips for you showing that, where he says that, employers cannot really find employees. There's a lot of employers looking for people to work. People are not coming back to work. And so labor market is strong, unemployment is low. Consumers have good balance sheets. Consumers have cash, so they're spending that cash. Obviously, housing is really high. And so those are all of his indicators for saying that, we are in for a soft landing. As one of my friends and very wise man says, of course, we shall see. So let me show you a couple more of these that are, highlights that are really good. I picked out kind of the best parts of this that we can talk about that I thought would be really good for us. So let's watch the next one. Let's go back to screen share here, and here we go.
Economists who have advised Democrats and Republican presidents, who both said that, that the Fed is so far behind the curve on inflation that a recession is inevitable.
So, and as I said, I think we have a good chance to restore price stability without a recession, without a severe downturn, and without materially higher unemployment. And I mentioned the reasons for that. So I see a strong economy now. I see a very strong labor market, for example. Businesses can't find the people to hire. They can't find them. So typically in a recession, you would have unemployment. Now you have surplus demand. So there should be room, in principle, to reduce that surplus demand without putting people out of work. The issue will come that we don't have precision surgical tools. We have essentially interest rates, the balance sheet, and forward guidance. And they're famously blunt tools. They're not capable of surgical precision. So I would agree. No one thinks this will be easy. No one thinks it's straightforward. But there's certainly a plausible path to this. And I do think we've got a good chance to do that. And our job is not to rate the chances. It is to try to achieve it. So that's what we're doing. There are a range of opinions, though, and that's only appropriate.
Right. So Powell, obviously, what he's saying is, the Fed only has certain tools. So a lot of people, when I talk to them, they don't really fully appreciate that, the Fed doesn't have every tool in the toolbook, and their tools are pretty blunt. They can raise interest rates, they can change the balance sheet, things like that, and change monetary policy, but that's about it, right? And so they have to use these tools that are in their toolbox in order to keep inflation under control and keep the economy growing. while keeping price stability there and keeping employment high. And so that is what they try to achieve. Now, of course, sometimes they battle it out with the executive branch, with executive orders, and the Congress, and that branch of government that does their own thing as well. And that's kind of the interesting thing, and maybe the beauty, or maybe not the beauty, of the U.S. free market system, is that this is how it was set up and this is how it works. So the Fed is just one component of what's going on. So there's a lot of people that might, blame the Fed. Hey, why'd they raise rates? They shouldn't have raised rates, whatever the story is. But they are working within their confines to try to get, where they want to go. Let's take a look at a couple other things here.
And we look at it as our job to, given all the factors that are happening, to try to sustain maximum employment and price stability. So if the Congress or the administration has ways to help with inflation, I would encourage that, but I'm not going to get into making recommendations or anything like that. It's really not our role. We need to stay in our lane and do our job. When we get inflation back under control, then maybe I can, give other people advice. Right now, we need to focus on, just focus on doing our job, and I'll stick to that, stick in our lane.
So the idea here, guys, is that they can only do what they can do, right? And they want to stay in their lane. Which
income gaps were coming down, wage gaps. So it's a really great thing. We'd all love to get back to that place, but to get back to anything like that place, you need price stability. So we've been hit by historically large inflationary shocks since the pandemic. This isn't anything like regular business. This is we have a pandemic. We have the highest unemployment, since the Depression. Then we have this outsized response from fiscal policy and monetary policy. Then we have inflation. Then we have a war in Ukraine, which is cutting the commodity, patch in half. And now we have these shutdowns in China. So it's been a series of inflationary shocks that are really different from anything people have seen in 40 years. So we have to look through that and look at the economy that's coming out the other side. And we need to somehow find price stability out of this. And it's obviously going to be very challenging, I think, because you do have numerous supply shocks, which are famously difficult to deal with. So I guess that's how I think about it.
Hey, Chris.
Thank you. Chris Rugaber and Associated.
That was actually one of the most important parts of this talk, where Jerome Powell said that, pandemic caused a lot of shock in both supply chain demand with employment and a lot of inflationary things, because the fiscal policy that came out of that was printing a lot of money, right? So they've printed a ton of money, which of course is inflationary because it devalues the dollar. And at the same time, you have supply chain shock coming. We can throw the Russia war in there, and commodity changes and shifts and things like that, and everything else that's happened in the country. Water break. So when you put all of that together, what you get is a high inflationary situation, which we've had, and we get prices increasing, which is not a good thing for anyone. And what their job is, again, at the Fed and with Jerome Powell, is to get that under control, get inflation down to about 2%, which is where they want it. And at the same time, make sure that there's unemployment's low, the economy grows and stuff like that, which it did not. We saw a negative GDP number just recently. So interest rates are up, and what effect is that going to have on the housing market? So we got some comments here. Just figured I'd say hello to you guys. Sal, welcome to the show. And Sal says FJB. I got a shirt that says "Let's Go Brandon." I should wear that one time. So lots going on, guys, and what I wanted to show you really next is I wanted to turn to mortgage rates. So we've been talking a lot, of course, on the channel about the housing market. Now, what happens with the federal funds rate, you guys, just want to mention one more time, is that the federal funds rate is the rate at which banks lend money to each other. It's not necessarily interest rates. However, it affects interest rates, because if as a bank it costs me more to borrow money, then that means, of course, I'm going to charge more on the other side of that. So that has been reflected in the mortgage rates, and I want to show those to you so that you can see what is going on. Let's move this over. There we go, and up. Okay, so check this out, you guys. So this is mortgage rates Okay, and as you can see, mortgage rates are way up. Let's look at the 30-year fix. So where we started back in January was 3.3%. And if you look back last year, they were even lower than that. They were under 3%. So money was cheap. People were buying homes based on 3% interest rates. People were getting qualified based on 3% interest rates. And I'm going to talk about that for sure, because that has had a big effect on the real estate and housing market as well. Now check out rates. Since January, they've been going up, and right now, the average 30-year fixed mortgages as of last week, 5.4%. I think that's actually a little bit high. I think they're a little lower than that, but whatever. They've come down a little bit, somewhere around there. So I want you to see this. That is 2 full percentage point, 200 basis point of interest rate increase. Guys, that is huge. It cannot be overstated how big of a difference that is, and I'm gonna share with you why. So let's say, for example, you were a buyer of a house and you got pre-approved at 3.3%, and now the rates are 5.4%. Well, what you're gonna have to do is either your monthly payment is gonna go way up, 2 percentage points is a ton, right? Or you're going to afford less house. And what that does is take some of the buyers out of the market, take some of the demand out of the marketplace for housing. So whereas supply demand, may have been like this, you got you got demand up here, you got supply here, right? Let me put this on the other screen. So whereas, for a long time it might have been like this, if demand comes down, right? Now you have less buyers for the same houses. Now, my perspective on this, which I've shared on my recent videos, is that demand is still outpacing supply. This is a very specific graph and illustration, right, guys? So it was like this. Demand was up here through the roof. Supply was here. And then now demand is coming back down to meet supply, right? Now, if you get a balanced market, you're here. If demand goes under supply, that's when you'll see some downward pressure on pricing. And that's really what I've been talking a lot about on the channel here, because the housing market is all about supply and demand, you guys. People talk about all kinds of stuff. In fact, I posted my most recent video on Facebook, which I don't do all the time. Don't go on Facebook that much, but I posted it. I got some interesting comments on there. Some people that are thinking that the housing market is going to crash. Some people thinking that these charts aren't showing us exactly what we want to see, that there's going to be a huge change in the market. Buyers are dropping out, which they are. But as I've said, demand is still outpacing supply right now in the housing market. As long as that continues, we're going to see upward pressure on prices. At the same time, let me show you something interesting, guys. So the blue line is 30-year fixed. Okay, the purple line is the 5/1 adjustable rate mortgage. Now, when I say adjustable rate mortgage, a lot of people cringe because they think back to 2008 and the crash that happened there. I'm going to tell you why this is not like that in just a second. But let me just share with you my opinion and my perspective on what happens. So if the 30-year fixed mortgage goes from 3.3% up to 5.4%, and let's just say that you're a buyer and you got pre-approved at this number and that's the payment you were expecting, and now the mortgage rates have skyrocketed and they've gone way, way up. So as a buyer, you're like, okay, what do I do? Do I pay more for the same house, or maybe do I take out a different kind of loan? And a lot of buyers, what they're doing is they're switching back over to this 5/1 ARM. Now look at the rate on that, 3.67%. So pretty similar to the 3.35%. One caveat on that is typically you do have to still be approved on the 30-year fix, but if you want, you can take out a 5/1 ARM at the lowest rate, right? So what happens to that, guys, is that people will switch to this 5/1 ARM product. Now, what a 5/1 ARM is it's fixed for 5 years, and then it starts to adjust based on the prevailing rate at that point, right? So people will do that, and they'll say, okay, look, maybe I'm not going to stay in my house for more than 5 years, or maybe I can refinance later when rates go down. Now, historically, guys, a 5% interest rate, which is where we are now, is still a very low interest rate. I mean, I can show you the historical chart, and we can do that right now, right? And you can see that historically, interest rates at 5% is still very good. So let's go to the 30-year. Let's pull this up real quick, guys. Let me show you. And We'll move that over. So check this out, guys. So this is historically, and by the way, let's say hello. Philip, hello there, watching from South Dakota. Welcome to the broadcast. Thanks for being here. Welcome to the show. Appreciate you. So check this out. This is the historical interest rate figure. So this early 1980s, I always point out to my parents' chagrin that they bought a house right here, 1982, 1981, 18%, guys. And by the way, people were still buying houses at that time. So, a lot of people say, oh my God, the rates went up from, 3% to 5%. What are we going to do? We're doomed. But if you take a look historically, guys, check this out. And you guys, thanks for the thumbs up, everyone coming in. I appreciate that. The more of those we get, the more YouTube shows it to more people, the more people we get on the broadcast. So I appreciate you guys. So look at this, 18% in 1981, right? So interest rates right now are extremely low. Check this out. They've been on a downward path ever since then. But if you look, like even back in so 2007 was kind of where the market was crazy, but interest rates were at 6% and people were buying houses like crazy, right? And then of course they went all the way down here to under 3%, 2.65%. If you bought and you got that rate, congratulations, because now you got that rate for 30 years as long as you don't sell the house. And then now, of course, they've come up right here to 5.1%, right? So I just wanted to show you the historical perspective, because a lot of people will say, wow, interest rates are so high, we can't buy at this, that's going to cause the housing market to burst. But historically, that's just not true, right? So back to what I was saying. So mortgage rates. So what a lot of people will do, of course, is they will switch to a 5/1 ARM. And again, what a 5/1 ARM is, it's fixed for 5 years, then it starts to adjust after that. And that's okay. That's a fine product. When I bought my first house, we took out a 5/1 ARM. I wanted the lower rate. I wanted the lower payment. Totally fine, especially if you're starting out, right? So all good. You guys, thank you so much for tuning in to the show. I really appreciate you guys. Let's say hello. Another bystander is in California. Wish I could leave, but I work for the state. Love your show, brother. Thanks, brother. Appreciate you. Thank you so much for being on. And I totally understand that there's a lot of people that cannot leave. And quite frankly, like, I know we're switching gears a little bit, but for our family even, it was challenging, of course. Our family is still in LA, our friends are in LA, so that was a difficult decision, but ultimately, the conclusion I came to is long-term, for my kids, for our family, I really just wanted to be in a place like Texas, like the Dallas-Fort Worth area, which I love, and so much opportunity here and really love it. By the way, another bystander, there are state jobs in other places. Texas is booming. Other places like Florida. So worth a look if it's something that you want to do. And then Reba says, love Christy Noem because Noem, I think that's how you say her name, because Philip here is in South Dakota. So you guys, thank you all for being here. I really appreciate you guys. We're talking interest rates, mortgage rates, stock market based upon what happened yesterday, which is the 50 basis point rate hike by Jerome Powell and the Fed. So a couple of things I wanted to show you guys. We talked about mortgage rates and what has happened with mortgage rates. We also have, of course, the stock market. And the stock market has not been doing well for a very long time. And let's take a look at what's going on today with the stock market, because yesterday they kind of liked it. I don't know if that's actually the case today. So let's get you the right window here. We are going to go to bam right there. Okay, and let me show you what's happening. So this is our QQQ, which is the Nasdaq. And the Nasdaq, my friends, is not, I don't know what happened there. That's weird. Okay, there we go. QQQ, bam. Okay, so the Nasdaq is not happy, guys. So if we look at the Nasdaq here, yesterday we did see a bump. So we saw about a 3% bump after the rates came out, but that has been eroded today very quickly. So we're back to where we were. So stock market not really digging what's going on, and the stock market has been in a downward decline for a long time now. So if we look here, we have, let me just expand this out for you guys. So ever since, this is April, but I can, if I squeeze this a little bit, There we go. So check this out. So we had some highs over here. Stock market and we don't usually talk too much stock market, but I'm just doing it as a reference point so we kind of know what's going on with finance in general and also how that affects the mortgage market and the real estate market. So if I take a look at this, we got, NASDAQ high was right here, about 400 is where we were. I don't know what's going on with this thing here, but 400, 392, and we are down yesterday or a couple days ago, May 2nd, down to 313. That is huge. That is a big drop in the stock market, right? And so we did see a little bit of a bump, but we're back down. For those of you who are, anyone interested in Bitcoin here and in cryptocurrencies, let's take a look at cryptocurrencies. So cryptocurrencies, let's go to the weekly chart. Here we go. Of course, we saw all-time highs in cryptocurrencies, back 2021, and we're now seeing a little bit of a bump. So not much going on. We've been kind of trading sideways there in crypto. Yesterday, we did see a bump after the Fed meeting, and then we kind of came back down from that, right? So that's the overall thing of what's going on. So, guys, what are your thoughts on the 50-point rate hike? This was already pretty much built into the market, in my opinion. Everyone expected this. This wasn't a surprise. This wasn't something new that we didn't expect. And the markets, at the end of the day, whether we're talking mortgage market, real estate market, stock market, the markets like stability. They don't like instability. They don't like indecision. They don't like fear of not knowing what's going on. In this case, we pretty much expected this because Jerome Powell said that this is going to happen, that they're going to continue to raise rates. Either that's 50 basis points or 25 basis points. So we knew that was going to happen. Already pretty much been baked into the market. And so nothing really that crazy happening. On the real estate side, guys, as I showed you the chart, historically these rates are not that high. They're still in that 5% range, which is pretty normal. So if you're looking to buy a house, and this was the other conversation that happened on my Facebook group. So on Facebook, I posted my last video. I had some people saying, real estate market's going to crash. Don't buy. You should wait. Well, the question there, whether you should wait, really ultimately depends on, and on the last live, I had someone ask, should I buy or wait? It depends on what your motivation and your goals are. Again, if you are buying a single family home for yourself to live in, for your family to live in, there's no real reason to wait, because by waiting, what will happen is interest rates might go up more, prices might stay the same. Now you're in a worse position. We've had so many clients, so I still run a real estate team out of LA actually, and we've had so many clients that have been waiting. They've been waiting for the crash, right? And Claire, thanks for being on, and thank you for your great comment. You also said that you heard the rate hike wouldn't be good for crypto. It hasn't really affected much, so we'll see where that goes. Right now, we're just kind of seeing some sideways trading in crypto, right? So, I had some of these comments, and we've had so many people that have said, oh, I'm waiting for the crash, and they've been waiting for 2 years. Meanwhile, prices are up 30%, 25%, interest rates are up a little bit, but they lost out on all that appreciation, tax advantage, not to mention living in their own home. They're still renting. So, waiting when you're buying your single family home, there really isn't much of a reason to do that. It typically does not work out. I actually want to show you an interesting chart. So we're going to go back to Fred here, and I'm going to show you this chart here, not this. Let's go back to, let's go back to this. Okay, so guys, check this out. So here's our median housing price chart. And the reason I want to show you this is I want to talk to all of the people who predict doom and gloom. These are all the people that predict housing market crashes. And if you predict a crash all the time and you do that for years on end, at some point you're going to be right. So I just want to point that out. But check this out, guys. So let's just say that, you're one of these people who you're constantly waiting for the market to crash, right? Well, what happens is, unless you bought at the very peak, so let's just say hypothetically that you had like the absolute worst luck in real estate, absolute worst luck. And what you did is you bought at the very, very height of the market, which was Q1 2007, okay? That's when you bought. Now check out this chart. It would have taken you, I want you to remember this number, 257,400, okay? It would have taken you, boom, 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 almost there, there we go. Q1 of 2013. It would have taken 6 years to get back to where you purchased, right? So if you bought in 07 and you waited, your house that you bought, it would have taken 6 years to get back to where you were. But check this out, guys. The average person stays in their home at this point somewhere between 7 and 10 years, right? So even if the housing market went down, you had your interest rate locked, you had your payment, and 6 years later, you're back to where you were, and then boom, you start to see all of this appreciation. But when you think about it, guys, there aren't that many people that were that unlucky that bought right there. And my point on this is, look, let's say, and I remember, so I got out of law school, I'm gonna tell you guys a little story. I got out of law school in 2001, and at that time, I remember I was working at a law firm and everyone was saying, the housing market's in a bubble, it's gonna crash, don't buy, don't buy, don't buy. Well, look, if you waited, like let's just pick a date. Okay, I bought my first house, actually this is a good place to pick a date, in 04, okay? So if I bought it in Q2 of 04. So if I would, no, I'm sorry, Q1 of 04. If I would have waited, if I would have said, you know what, I'm gonna wait for the market to crash. Well, guess what? In 07, it finally did, but check this out, guys. If I would have waited, so Q1 04, median price 212,000. Well, if I would have waited, it would have run up to 257 and run all the way down. But the lowest point was 208, a little bit under that Q1, right? So if I would have waited, really, it wouldn't have done me much good because I would have had to have then timed the market perfectly and bought in 09 in order to take advantage of this run. But really, guys, who knows? I mean, how in the world would I know that this was the bottom and that now I need to buy? So I wouldn't have timed it perfectly anyway. So I would have either bought here or I might have bought here. So the moral of the story, guys, is if you're buying a principal residence, I want you to remember this one thing. It is not about timing the market, and this goes for the stock market as well. It's about time in the market. So if you're buying your first house, your second house, your principal residence, my advice is always, don't try to time that market. Try to find a great house, a great deal if you can, area that you want to be in, that you plan on staying for at least 7 years on your principal residence. Lock in a great interest rate. If you want to take advantage of the ARM, if you think interest rates are going to come down later, you can do that, whatever your inclination is. Lock in that house and move on. Okay, there has never been, if you look at this housing market, I just showed you the chart, there has never been more than a 7-year period, or there's never been a 7-year period where the housing market has been down. So if you plan on staying in the house for 7 years, you have zero to worry about as long as that holds true. Now look, guys, I can't predict the future, but I do know that the past is a pretty good indication, especially when it comes to real estate, which is really a tangible asset like that, right? So that's my take. Now, if you're an investor, it's a little bit of a different analysis because you can get caught in these swings. So just be careful if you're an investor. Make sure you bake in some extra margin, some extra room into your analysis so that you don't get stuck, right? And so that's kind of what's going on right now, you guys. Any questions? If you got questions, throw them in the chat box. I'd love to answer them for you here. We could talk real estate. We could talk finance, we could talk politics, whatever you want to talk about. Throw those in there, happy to answer them for you because, it's an interesting time for sure. Do you think there's going to be a soft landing like Jerome Powell wants, or are we going to see more of kind of a crash? And by the way, on this chart, let me show you the chart again. Obviously the scary thing on this chart, guys, if you look at it, is this crazy run up right here. Let me go into this a little bit more. So look at this crazy run up right here. That is not sustainable. We went from 322 on the median national house price in 2020 all the way to 428 $4,700 on the median price only 2 years later. For you guys that can do some quick math, you know, that's like a 30% run up, a little more. 322 to 428, it's like over a 30% run up in 2 years. That is not sustainable, guys. And if you look at the chart, if you just look at the chart of housing, you can kind of see the trend line, right? Fred doesn't do trend lines, but you could see it. You know, you could see the trend line here. We went above the trend line. We kind of came back down to it. You know, we were kind of moving forward, and now, bam, we're way above the trend line. So do I, if I had to draw this chart out further, do I expect this to come back down to the trend line at some point? 100%. Is that going to be a bam crash kind of like this, or is that going to be more of a softer kind of correction, right? Like that. So that's yet to be seen, of course. We shall see what happens. It's going to be really interesting, but ultimately the advice I gave you still holds true. You're buying that single family residence, you know, find that house you love, jump in there, take advantage. If you're staying for 7 years, you should have nothing to worry about. If you're an investor, just bake that into your margin. Now, one more thing, if you're selling a house, you know, people have asked me when's the best time to sell. Summertime, typically one of the best times. A lot of houses come on the market. We're starting to see a lot more inventory. I will touch on the fact that we're starting to see some price drops. I don't think that's because the market's coming down. I think that's more a function of people are getting super aggressive with their pricing. You know, the neighbor sold for $1 million, I'm gonna list for $1.1 million. The neighbor sold for $1.1 million, I'm gonna list for $1.2 million because I can get whatever price I want. That doesn't last for very long because people see through that. People start saying, wait a second, you know, I'm not crazy, I'm not gonna pay you 20% over the last house, that sold a month ago. So you'll start to see some price decreases, more a function of sellers just getting really aggressive on their pricing. So, hey, with that being said, though, there's some deals to be had. There are some things that might be really overpriced, right, that you could take advantage of. And thanks for the thumbs up when you get in here on the way in. Thanks for that. Give me a big thumbs up. That shows the video to more people on YouTube. So guys, that's my take on it. You know, the Fed raised those interest rates and mortgage rates are up, but demand is still strong in the housing market. Do I see a huge crash? No, contrary to what a lot of people say on YouTube. And we talk about freedom and finance and fun on the channel for sure. So lots of good stuff. Oh, here's a question coming in. Okay, so Blaine, question. What is the best area to buy for a personal residence, Dallas, for a family? Flower Mound. Blaine, you thinking of coming, man? Come on out. Okay, so let me give you my perspective. I've been here for less than a year, but let me tell you my perspective on the North Texas DFW kind of suburb area. So we moved to a city called Southlake. I don't know if I'm allowed to say that, but you know, who cares? So we moved to a city called Southlake, which I absolutely love. Great schools, amazing community. It is a little bit more expensive, and the property taxes are a little bit more expensive because of the schools. Now, there's a lot of cities around Southlake in the North Texas area. Flower Mound is one of them. We have some good friends that moved there that absolutely love it. So I think Flower Mound's great. There's a lot of other cool areas, Grapevine, Keller, all around here. I would say can't really go wrong, and it depends on obviously what your goals are and what you're looking for. For us, schools, community were really the #1 most important thing. And so we really picked this area. Someone just mentioned Frisco, Carrollton, Plano. Also great areas. I have a lot of friends that have moved to Frisco and Plano. That is a little bit east of us. Also North Texas. Also great areas. So there's so many here that are awesome that we absolutely love it. Schools-wise, Blaine, thank you for asking. You know, Southlake has been historically one of the better school districts in the state, but then there are other ones around here as well. You know, so like I said, Flower Mound has a great school district. It's a little bit smaller. Johnny, my Doberman, is saying hello, barking at someone. So lots of great areas around here, and you know, I definitely invite you to check it out. And if you come out here, let me know. We'd love to say hello, show you around the areas here. So Southlake, you know, Flower Mound. all those places are great. And then Frisco is also awesome. I've been headed over there and checking that out and kind of exploring all around this North Texas area, which we absolutely love. Well, guys, thank you for tuning in today to another live. I really enjoy these. I hope you do too. Thanks for tuning in. Thanks for watching this. We'll post some summary videos out on the channel, so make sure you're subscribed and make sure you hit that bell icon so that you get the notification every time a new video comes out. And I will see you guys on the next video or on the next live. Thanks for tuning in, guys. Catch you soon.